Hey, what's up? Welcome to my channel, where I share with you the best tips and tricks on investing and personal finance. I'm your host, and today we're going to talk about one of the most legendary investors of all time, Warren Buffett. You probably know who Warren Buffett is, right? He's the guy who started with $10,000 and turned it into over $100 billion by investing in the stock market. He's also known as the Oracle of Omaha because he has a knack for predicting the future of businesses and industries. But do you know what his approach to dividend investing is? Dividend investing is a strategy that involves buying stocks that pay regular dividends, which are distributions of profits to shareholders. Dividends can provide a steady income stream, reduce volatility, and compound returns over time. Warren Buffett has a unique philosophy on dividend investing that differs from many other investors. He doesn't chase high-yield stocks or focus on dividend metrics. Instead, he looks for outstanding businesses that can pay sustainable and growing dividends over the long term. In this video, I will discuss Buffett's approach to dividend investing and how you can apply it to your own portfolio. By learning from Buffett's approach, you can improve your own dividend investing strategy and achieve better results. So if you're ready to learn from the master of dividend investing, make sure to hit the like button, subscribe to my channel, and turn on the notification bell. Let's get started. Warren Buffett's philosophy on dividend investing. Warren Buffett loves companies that generate cash and share profits with shareholders. He once said, "Our favorite holding period is forever." This means that he likes to buy and hold stocks for as long as possible, as long as they keep paying dividends. But how does he find these companies? He focuses on identifying outstanding businesses with potential for sustained dividends. He looks for businesses that have strong competitive advantages, loyal customers, consistent earnings growth, and low debt levels. He also uses a metaphor of the health and productivity of a tree over a lifetime to illustrate his dividend investing philosophy. He compares buying stocks to buying hamburgers and says that as long-term investors, we should prefer lower prices because we can buy more shares with the same amount of money. He applies this logic to dividend investing and says that we should prefer companies that reinvest their earnings rather than pay out high dividends because reinvestments can increase the future value of the business and hence the future dividends. He explains this analogy in his own words. If you expect to be a net saver during the next 5 years, should you hope for a higher or lower stock market during that period? Many investors get this one wrong. Even though they are going to be net buyers of stocks for many years to come, they are elated when stock prices rise and depressed when they fall. In effect, they rejoice because prices have risen for the hamburgers they will soon be buying. This reaction makes no sense. Only those who will be sellers of equities in the near future should be happy at seeing stocks rise. Prospective purchasers should much prefer sinking prices. Understanding Warren Buffett's investment philosophy. Buffett's dividend investing philosophy is based on his broader investment philosophy, which is value investing. Value investing is an approach that involves buying stocks that are undervalued by the market based on their intrinsic value. Intrinsic value is the true worth of a business based on its future cash flows. Buffett learned value investing from his mentor, Benjamin Graham, who is considered the father of value investing. One of the key concepts of value investing is the circle of competence, which means that investors should only invest in businesses that they understand well. Buffett advises, you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Another key concept of value investing is the margin of safety, which means that investors should buy stocks at a significant discount to their intrinsic value to protect themselves from errors in estimation or market fluctuations. Graham defines it as, the margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. Emphasis on quality over quantity in dividend investing. Buffett emphasizes quality over quantity in dividend investing. He prefers healthy, stable businesses over high-yield stocks. High-yield stocks are those that pay high dividends relative to their share price, but they may not be sustainable or reliable in the long term. Buffett looks for businesses that have strong competitive advantages, loyal customers, consistent earnings growth, and low debt levels. These qualities make a business more resilient and profitable in any economic environment and allow it to pay steady and growing dividends over time. Buffett also focuses on the health of the underlying business rather than the dividend yield or payout ratio. Dividend yield is the annual dividend per share divided by the share price, and payout ratio is the percentage of earnings that are paid out as dividends. These metrics can be misleading because they do not reflect the true value or growth potential of the business. A low dividend yield or payout ratio may indicate that the business is reinvesting its earnings to grow its future cash flows and dividends, while a high dividend yield or payout ratio may indicate that the business is struggling to maintain its earnings or dividends. The role of retained earnings in his investment strategy. Buffett appreciates companies that reinvest their retained earnings rather than pay out high dividends. Retained earnings are the portion of earnings that are not distributed to shareholders but are kept by the company for future use. Reinvesting retained earnings can increase the value of the business and hence the value of the shares and dividends in the long run. Buffett compares reinvestments to a diligent gardener planting seeds that will grow into fruitful trees over time. Buffett evaluates how well a company uses its retained earnings by looking at its return on equity, which is the ratio of net income to shareholders' equity. He prefers companies that have high ROE and low payout ratio, which means that they are able to generate high returns from their investments. He also considers the connection between dividends, intrinsic value, and margin of safety. He says that dividends are only one component of intrinsic value, which also depends on future earnings growth. He says that paying out too many dividends can reduce the future value of the business, and hence the margin of safety. Case studies of Warren Buffett's dividend investments. Let's look at some examples of Warren Buffett's dividend investments and see how they fit his philosophy. Here are 3 of his most famous dividend stocks. Coca-Cola. Buffett bought Coca-Cola in 1988 and has held it ever since. Coca-Cola is an example of a stable and growing dividend stock. It has a strong brand, loyal customers, consistent earnings growth, and low debt levels. It has paid dividends for over 100 years and has increased its dividend for 59 consecutive years. It currently has a dividend yield of 3% and a payout ratio of 77%. Apple. Buffett bought Apple in 2016 and has increased his stake over time. Apple is an exception in the tech sector with significant dividend contributions. It has a dominant position in the smartphone market, loyal customers, consistent earnings growth, and low debt levels. It has paid dividends since 2012 and has increased its dividend for 9 consecutive years. It currently has a dividend yield of 0.6% and a payout ratio of 18%. American Express. Buffett bought American Express in 1964 and has held it ever since. American Express is a lesson in long-term dividend investing. It has a strong brand, loyal customers, consistent earnings growth, and low debt levels. It has paid dividends since 1870 and has increased its dividend for 10 consecutive years. It currently has a dividend yield of 1% and a payout ratio of 15%. Lessons from Buffett's dividend investing strategy. What can we learn from Buffett's dividend investing strategy? Here are some key takeaways. Importance of understanding the business for assessing dividends. Buffett says that he only invests in businesses that he understands well and can evaluate their future prospects. He says that dividends are only one aspect of a business's performance and value. Emphasis on patience as a strategic weapon for dividend investing. Buffett says that he likes to buy and hold stocks for as long as possible, as long as they keep paying dividends. He says that patience allows him to benefit from compounding returns and avoid unnecessary trading costs and taxes. Evaluating management's approach to capital allocation. Buffett says that he looks for companies that have competent and trustworthy management teams that can allocate capital efficiently. He says that he prefers companies that reinvest their earnings rather than pay out high dividends, as long as they can generate high returns from their reinvestments. Risks and limitations of Warren Buffett's approach. Of course, no investment strategy is perfect or risk-free. There are some risks and limitations of Warren Buffett's approach to dividend investing that you should be aware of. Reliance on strong company management and its potential risks. Buffett trusts the management teams of his portfolio companies to make the best decisions for their businesses and shareholders. However, this also means that he is exposed to the risk of management errors, fraud, or changes. For example, in 2020, Buffett sold his stake in 4 major U.S. airlines after they suffered huge losses due to the COVID-19 pandemic. He admitted that he made a mistake by investing in them and blamed himself for not anticipating the impact of the crisis on the industry. Potential for missing out on high growth, low dividend sectors. Buffett tends to avoid investing in sectors that he does not understand well or that have low or no dividends. For example, he has largely avoided investing in the tech sector, except for Apple and a few others. He has also missed out on some of the most successful tech companies in history, such as Amazon, Google, and Facebook. He once said, "I don't know what that world tech is going to look like in 10 years. I do know what the world will look like in 10 years with Coca-Cola and See's Candy and Wrigley's Gum and all that." Limited applicability for short-term or income-focused investors. Buffett's approach to dividend investing requires a long-term investment horizon and a focus on capital appreciation rather than income generation. He says that he does not care about the dividend yield or payout ratio of his stocks, as long as they increase their intrinsic value over time. He also says that he does not need dividends to fund his lifestyle, as he lives modestly and reinvests most of his earnings. However, this may not be suitable for investors who have different goals, such as generating income in retirement or meeting short-term financial obligations. How to apply Buffett's dividend investing principles. How can you apply Buffett's dividend investing principles to your own portfolio? Here are some tips. Tips for identifying strong dividend companies. Look for companies that have strong competitive advantages, loyal customers, consistent earnings growth, and low debt levels. These qualities make a business more resilient and profitable in any economic environment and allow it to pay steady and growing dividends over time. You can also use some financial ratios to screen for these qualities, such as return on equity ROE, earnings per share EPS growth, debt to equity ratio D/E, and dividend payout ratio DPR. Importance of maintaining a diversified portfolio. Even though Buffett likes to buy and hold stocks for as long as possible, he also diversifies his portfolio across different sectors, industries, and geographies. He says that diversification reduces the risk of losing money due to unforeseen events or market fluctuations. He also says that diversification allows him to take advantage of opportunities in different areas of the market. You can also diversify your portfolio by investing in different types of dividend stocks, such as blue chip stocks, growth stocks, value stocks, and international stocks. Value of a long-term investment horizon. Buffett says that he likes to invest for the long term and ignore the short-term noise of the market. He says that patience allows him to benefit from compounding returns and avoid unnecessary trading costs and taxes. He also says that patience gives him an edge over other investors who are more emotional or impulsive. You can also adopt a long-term investment horizon by investing in dividend stocks that have strong fundamentals and growth potential, rather than chasing high-yield stocks or following market trends. Warren Buffett's dividend investing approach. In conclusion, Warren Buffett's dividend investing approach is based on his broader investment philosophy of value investing. He looks for outstanding businesses that can pay sustainable and growing dividends over the long term. He prefers quality over quantity in dividend investing and focuses on the health of the underlying business rather than the dividend metrics. He appreciates companies that reinvest their earnings rather than pay out high dividends because reinvestments can increase the future value of the business and hence the future dividends. However, his approach also has some risks and limitations that you should be aware of. He relies on strong company management and its potential risks. He may miss out on high growth, low dividend sectors that he does not understand well. He may not be suitable for short-term or income-focused investors who have different goals. You can apply his dividend investing principles to your own portfolio by following some tips. You can look for strong dividend companies that have strong competitive advantages, loyal customers, consistent earnings growth, and low debt levels. You can maintain a diversified portfolio across different types of dividend stocks. You can adopt a long-term investment horizon and be patient with your dividend stocks. I hope you enjoyed this video and learned something new from Warren Buffett's approach to dividend investing. If you did, please hit the like button, subscribe to my channel, and turn on the notification bell. Also, feel free to leave a comment below and share your thoughts or questions on dividend investing. I would love to hear from you. Thank you for watching, and I'll see you in the next video. Until then, happy investing. Disclaimer: this video is for educational and entertainment purposes only. It is not intended to be financial advice or a recommendation to buy or sell any stocks. Please do your own research and consult a professional before making any investment decisions. I am not affiliated with or endorsed by Warren Buffett or any of the companies mentioned in this video. All opinions expressed are my own and based on publicly available information.